Hey everyone, welcome back to Fiscal Voyage. I'm Felix, and today's video we're going to talk about two stocks that reported earnings. We're going to look at the earnings and some of the key things that I like. And these two stocks had a big drop in the stock price, and I'm looking to buy more shares of these stocks. I currently own both of these stocks, and I'm down on both of them. One of them, about maybe 1 or 2%. The other one around like 10 to 12%. And I'm looking to buy more shares. And the stock that I'm going to be covering first is Comcast, CMSCA. If we go to the max chart here and remove the price of the chart, you can see her earnings have been going great, 23% compounded annually over the past 20 years. Really the only down year they had was in 2020 with a 17% decrease in earnings from 313 to 261. And you can see here they reported earnings, which is actually $4.33 for 2024 total, and it's an increase of 9%. But next year they're expected to just have a flat year, around a 1% increase, but then picking up very nicely in 2026 and 2027. Now, when we put the price on the chart, you can see here how undervalued this stock is. And last time when it bounced, it was around $30, and it bounced all the way up to $46. So I'm kind of expecting the same thing, and I'll show you why technically later. But overall, you can see here, this is very undervalued. So I'm not expecting the stock to grow at 23%, but it was short in this time period, around maybe up to here. You can see here, 8% grower. And 2026, they expect 11%, and 2027, 6%, so around 8% in between. And you can see here, if we revert back to a normal multiple in this past 3 years of 11, which is still a very low multiple, we can have a 23% annual rate of return of this stock if we purchase at today's price around $33. And it had a dividend yield of 3.7, which is very nice yield. And they actually increased the dividend about 6% a few days ago. So I like that a lot. S&P credit rating of A-, which is an investment grade. The long-term debt to cap is pretty on the high side, at 52%. But overall, this looks great. Operating cash flow covers the dividend very nicely. You can see here, free cash flow, if we go excuse me, if we go to free cash flow, you can see here also covers the dividend very nicely. And sales has been growing year in and year out as well. You can see here, they're expected for 2025 to have a flat year. Same thing with earnings, but then picking up 3% in 2026. But overall, you can see here, sales has been growing very nicely. It has a normal blended price to sell around 1, and we're getting it right now at 104, or excuse me, sales, where is it? Blended around here, 1.49, and we're getting here at 1.04, or 1.04, yeah. And so that looks very undervalued based on price to sell. EBITDA, you can see here undervalued as well, based on EBITDA performance historically. And forecasting long-term growth, you can see here expected to grow around 5%. So overall, everything looks great here. Now, if we go, why did the stock drop so much? If we go to their earnings, what I like here, you can see here, adjusted earnings grew 9%, $4.33 from 2023 to 2024. Adjusted EBITDA grew at 1.2%, and revenue grew at 1.8%. So that looks great. And then if we go over here, that's the next stock. If we go here, you can see here, net income grew. This is for, let me go here. This is for 2023 and 2024. Net income grew, which is great. Diluted earnings grew as well. And the average common shares decreased, which is good. So the earnings grew as well as from the decrease in shares. And then you can see here, increase the dividend by 8 cents, which is 6.5% increase year over year to $1.32 a share on an annualized basis for 2025. And that's the 17th consecutive annual increase, and they increase the share repurchase authorizations to 15 billion. So it's all good things. I like that a lot. And if we go to CFRA, it gives it a buy rating. You can see here, buy rating with a price target of $50, earnings 3-year earning growth of 7%, and a fair value of 41. So CFRA agrees also is undervalued. Morningstar 5-star rating with a fair price of $49, and the price is at $37.36. But right now it's actually less. if we go here, this current price is $33.66, and it had an update today. But I'm thinking I'm gonna be buying shares of this stock on Monday because I like it a lot and I own shares currently, and I want to increase my position. Now if we go technically, you can see here on the 3-month chart is right at that 50 moving average here. It could go lower. It could actually go down to $30 over here, which was the 2022 lows here, October, July and October here. It could get that low, $30. I'll buy more shares, but I think right now is a good buying opportunity to pick up more shares. That's on the 3-month chart. You can see here right on the 50 moving average. And on the monthly chart, it has room here again, back to $30 right here in the support area. Strong support. So I kind of expected here, because you can see here around here, $30 here, around $30 here, $30 here, and then we got the moving average, the 200 moving average on the monthly at $30 here as well. And this is the 08-09 crash. You can see here, great opportunity to buy it around $7, $8 here, even though it went lower down to $5.55. Still good buying opportunity to buy it here right at the 200 moving average on the monthly chart. So you can see here on the daily chart, it had earnings, and then it had a gap from $37 all the way down to $32. So I want to buy more shares because possibly there could be a gap fill and just head higher. But because of all the things we looked at, earnings, CFRA, Morningstar, Fast Graph, all looks nice. It looks good to increase shares, appreciation. Head back all the way up to maybe around $80, $70, who knows. But in the meantime, we're collecting almost a 4% yield, a growing dividend yield, solid company, 17 years of dividend increases, A- credit rating. Everything is good to like. So I'm looking to buy more shares of Comcast. The next stock I'm looking at is UPS. UPS had a decrease in share price as well. And you can see here, the earnings are $7.72, and we're gonna go there. You can see here, if I go to they reported $7.72, but what dropped the price was the their biggest customer or client is gonna decrease volume by 50% or a little more than 50%. So that drove the price down. But based on that, over here, lower volume is a minus, volume reduction from our largest customer, but some pluses: increase in revenue per pieces, improved customer mix, lower costs, lower capex, which increase free cash flow, operating margin, and return on investment capital. And then for 2025 outlook, revenue is going to be about flat or slightly negative compared to 2024. Free cash flow around the same area of 2024. The dividend payout is actually going to be increased. It looks like approximately $5.5 billion, and share repurchase at $1 billion. So that looks good. That looks promising. And this is a solid company. People are always buying online, and we need logistics to get our products, right? Our things we buy online to be delivered to our homes and businesses. So I don't see that going anywhere anytime soon, right? Because you order most of my things that I buy are online. So I buy a lot of things online, and I like it a lot. And I don't see myself stopping, buying online. Obviously Amazon is a competitor. Then you got FedEx, another competitor. But I think, UPS is, well brand, solid brand, has a A-rated credit rating, 55% long-term debt to cap, looks solid. Operating cash flow covers the dividend. Free cash flow slightly covers the dividends. It has a high payout ratio, but not too concerning. They're forecasting long-term growth. You can see here they're expecting around 4% in growth. And if we go to revert back to a normal multiple, say around here, to around a 16 multiple at the current price, we could get a 20% annual rate of return, so which is great. The dividend yield is very high at 5.67. Earnings yield is almost 7%. So there's a lot of things I like about this. Now, if we go to CFRA gives it a buy rating, and the current price for UPS is $114. So you can see here they haven't updated this. So the 12-month price target might be lower, maybe 130, but you're still maybe around 15-20% under their 12-month price target. They have a 3-year projected earnings growth of 13. And if we go to the fair price here, you can see here around 109, so it's kind of like right at that fair price that they expect. Morningstar gives it a buy rating with a 4-star, almost $140 fair value. So it looks undervalued based on Morningstar has a wide moat, so I like that a lot. And now we go technically to UPS. You can see here it's kind of the same story. On the 3-month chart, you can see here we're under the moving average. You see here it bounce here, bounce there here, but we're kind of under it. But we're extended. You know, all these red on the 3-month chart. It's time for, you know, some green. So that's kind of what I'm expecting. And now if we go to the monthly, look where it landed right here. Look where it stopped at $111 right there. Boom, you buy it. Now it's up, you know, about $4, $3. So that's why I kind of like it a lot. You know, over here during COVID lows, it stopped right there at $80. So this monthly moving average looks very solid. So I kind of, you know, I'm going to probably buy shares of this as well on Monday. Just another lot. And then after that, I'll just wait to see if it gets around the $90 area, and then I'll buy more shares. So wait for another earnings report to see what's going on. But that's kind of my play there for UPS. And you can see here on the daily chart, you know, it dropped from 134 all the way down to 109, and then it had a big, you know, rally from 109 to 115, and then now it's at 114. So I think I might buy shares on Monday, see how it opens, and buy shares of UPS and shares of Comcast. So those are the 2 stocks that I'm looking to buy next week coming up, and we'll see how that goes. Thank you for watching. If you're new to the channel, make sure to hit the subscribe button and like this video for more videos like this. Thank you, and I'll see you guys in the next one.